We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome back to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Christian, Managing Partner of the CPM Group. Jeff, thanks for joining me today.
It's my pleasure, Tom.
So for those that aren't familiar, can you explain what the CPM Group does and how much experience you have in the silver market, please?
Okay, well, the CPM Group is a commodities research consulting company. We've been around for 35 years as of this month. We were set up as CPM Group in May of 1986. The research operation actually goes back to the late 60s, early 70s. I personally studied journalism, international economics, that's the Soviet poster, and political science in university. And at that time in the mid-70s, a lot of the international economics was commodities-based. After university, I became a business journalist, and I wrote about precious metals, electric vehicles, solar power, oil and gas, and a variety of other things. In 1980, I was tired of being a journalist, and I went to a company, J. Aron. J. Aron was an independent commodities trading company at that time. And in fact, up until really 1980, 81, 82, most commodities trading companies were independent. They weren't part of a larger brokerage house or investment bank. And that's actually important to understanding the dynamics and mechanics of the markets. Prior to that, these were like family companies, mostly. And J. Aron was a family company. Actually, it was a merger of two family companies. And Aron in the 60s had created this research department. J. Aron and Handy and Harman were the two sources of silver data. J. Aron and Consolidated Goldfields were the sources of gold data. And no one was publishing Platinum Group research until I took over the research operation at J. Aron in 1980. And these are all very secretive markets. And it's very funny because I mentioned that in some other interview. And somebody said, oh, secretive because they're manipulated. It's like, no, they're secretive because they're precious metal. I mean, one of the attractions for everybody in precious metals is the secretiveness, and it's nobody's liability, it's nobody's business, and that's true of everybody. So, you sign them, you guys say, well, I think the big banks should be required to disclose their gold positions. You say, okay, well, where do you draw the line? What's a big bank that's required? And, maybe everybody should. Why don't we start with you? Well, I'm not going to tell you how much gold I have. Okay, well, now you understand. And precious metals are very secretive. They're largely unregulated on a global basis. And so J. Aron had developed a capacity to develop estimates of secondary recovery from old scrap. I mean, mine production is relatively easy to get because you have mining companies that are publicly traded. They have regulations that they have to require that report their production and financials, and they have an incentive to report that because they want investors to buy their stock. But secondary recoverers are private companies. There's no regulatory obligation to report what you're doing, and there are competitive and economic reasons not to be secretive. So they're secretive. And the same is true with all of the fabricators. They're largely private companies. And even if they're public, there's no requirement that they say, well, these are the raw materials that we're buying. And then there's the investor community. And back then, the central banks were extremely secretive too. So you had Aron and Aron's research group developed the capacity to get this information and make estimates of how much metal is coming, not only from mines, but secondary recovery of scrap, how much is being used in fabrication in different products in different countries, and then also investment demand and central bank activity. And I took over that research operation in 1980 at J. Aron. We merged into Goldman Sachs in 1981. A lot of people quit J. Aron as soon as Goldman bought them, and I didn't understand why. And I've often thought, I'd be a much wealthier and happier person if I had left with them, but I stayed. And I ran the Commodities Research Group at Goldman Sachs 1981 until 1986. 1983, they had me cut back 30% of my staff. 1984 was another 15%. And at that point, I said, look, I can take my department, spin it off, move across the street. You can outsource your commodities research to us, and we'll cut your budget in half. Forget the 15% reduction, 50% reduction, and let me go free. And there were a number of reasons why I didn't want to be at Goldman Sachs. I didn't want to be at a bank. I saw the inherent conflicts of a research department being part of an investment bank and a trading bank, trading company and stuff. I wanted to be independent, and I wanted to do other things too. So they said no. They gave me a raise. They gave me a promotion. They gave me a physical. They gave me an extra week's vacation, and I stayed until 1986. In 1986, I could see that Goldman was reconsidering being involved in precious metals because they were asking me questions of the head of research. And I reproposed that I spin off the research department, and they struck my bid. So we set up as an independent research company. We do a lot of primary research. Our precious metals research is superior than other people's because we're not marketing agents for people. So we don't do stuff like count forwards as a form of spot physical purchases and sales. And we don't throw investment demand in with fabrication demand to make the markets look like they're tighter than they really are. And because we were at JM and Goldman Sachs, we were involved in a whole lot of stuff. We were some of the earliest people leasing gold from central banks. We were involved in one of the first two gold loans to a mining company to provide project financing through a gold loan as opposed to a dollar loan. We did a lot of work on options and stuff like that. So we have this hands-on knowledge of the market, how things work. And in some ways, we're often proven to be more attuned to the financial aspects than some of the traders that are left in the markets. Mm-hmm. You know? And so for 35 years, we've been an independent company. Most of our revenue actually comes from investors, institutional investors, large wealthy investors, family offices, and some retail investors, and companies that amalgamate retail investors. So most of our work is on that side. The second largest source of revenue comes from mining companies. It's interesting because there are people who don't know who we are, who think that we're beholden to the banks and stuff. And I say, yeah, well, look, go to the LBMA website, see the last time they used us. And let me know, because I don't think they've ever used us. I know when the LBMA was created, we said, hey, do you guys want to work with us? And they said, we would never work with a company that's not based in London. So, and I said, well, we actually have a London-based person at the time. Actually, she was based in Bath, England. She had moved from London to Bath. But we have a UK-based person, and I'm spending 5 weeks a year in London. And they said, that's not good enough. You're still an American. So we're not going to do it. So we actually, if you look at the sell side, the banks, the Bullion banks and other people, they represent less than 1% of our business. And that's because the other 99%, we work with mining companies and we say, oh, you want a hedge? Here's a better hedge than what the banks are selling. We work with institutional investors and high net worth individuals. They say, this bank is showing me a silver indexed bond that they want to write. What do you think of it? And we say, yeah, I don't like that one, but here's a counter bid. Go back to the bank and say, I don't want to buy into your $200 million silver bond, but I would do this instead. So if you think about what we do, we skew the table in favor of users or consumers of financial transactions with our knowledge. So most mining companies, there's a guy who said, mining companies trade on the futures market. No, I don't know of a single mining company that trades futures, nor do I know of a single futures trader who works for a mining company. The mining companies tend to do over-the-counter trades with banks, and they don't necessarily understand what the transactions are. So they'll come to us, they'll be our advisor, we'll be their advisors, and we'll say, this is how you can better hedge, and you keep more of the gravy for yourself at the expense of giving it to the banks. So the banks actually don't necessarily like us, which is one of our better kept secrets, at least in that part of the market that just doesn't necessarily understand who we are and what we do. But that's what we do. We provide research and consulting on the financial management of commodities.
So, Jeff, as part of that, does the CPM Group actually write any derivatives into the silver market, like for miners?
We will not write the derivatives. We will trade for our clients, but we're never on the other side of them. So, and we don't necessarily write the derivatives, but we can actually structure them and price them and place them. So let's say that you have a mining company that wants to hedge. Traditionally, that mining company might go to one or two banks and say, I want to hedge. And the banks will say, oh, well, fixed forward. No, I want some of the upside. Okay, a collar. And then they come to us and they say, Jeff, what should we be doing? And we say, okay, let's do a participatory option. So let's buy that put, give you the floor that you want, and then you'll pay for it with a call spread. So you keep most of the upside. We structure it, go back to the banks say, oh God, taking away all of our profits. Mm-hmm. No, we're not. We're giving you a reasonable profit plus, and we're keeping most of the upside for our client. Then we actually can price that so that when our client, the mining company, says, okay, to the bank, what's your price for that hedge? We can look at it and say, they're $10 out of the market. Go back and say, no, we want a $10 better deal. Mm-hmm. So we don't actually structure and price. We will structure and price it, but we won't actually place it, in that we're not actually a derivatives dealer.
Okay, perfect. So Jeff, you recently released your annual silver yearbook, and along with it, you guys did a video presentation last week that's available on your YouTube page. So as part of the presentation, you discussed your outlook for the financial markets and expect the next global crisis to be between 2023 to 2025. What markets could spark this recession?
Well, most recessions start through the debt in this market. Interest rates and debt are really one of the major factors across economics in determining growth or recession. So if you look at many of the past recessions, many of them have been stimulated by a debt crisis. So we're looking at the debt market, and we're not quite sure where you're going to go. I mean, if you look at the world economy, you look at financial markets, you look at the political structure, there are these gigantic imbalances that have been building up for decades, a couple of decades. They got worse in 2008, 2011. They've gotten worse since then. And 2020, the pandemic and the lockdown have made them even worse. So there are these massive imbalances, not only in the debt and credit markets, but in currency markets and the political structure, and the amount of money outstanding. And those things have not been resolved. In some cases, they've gotten worse. And the regulatory reforms that we did with Sarbanes-Oxley in 2001, 2002, and with Dodd-Frank's after the 2008, 2009 crisis haven't really protected the structure from the next shock. So our expectation is that with these large imbalances there, you probably will have something happen in some obscure corner of the debt market. It won't be treasuries, because everybody's watching the treasuries. Mm-hmm. And the U.S. Treasury and the Fed have all kinds of ammunition left. Anybody who says they're running out of ammunition or they're losing control really don't understand what's going on there. It won't be treasuries. It'll be some obscure corner of the debt market where something's going to go wrong, and that will then cascade into other debt markets, and then you'll see a recession.
Mm-hmm. So you and I spoke last week to kind of prep for the interview, and you brought up something that I thought was really interesting. And what it was the shift in the stock market from, let's say, value creation to decapitalization. Could you go over that for us and tell us how share buybacks have really kind of ruined what these companies or what the stock market used to be?
Yeah, well, the stock market used to be where you went to raise capital to build your company or to expand your company, or to capitalize on the profits that you've made. And what we've seen really over the last 20 years or more is an increased amount of what we call decapitalization. So you see, and people say, well, okay, I see all this money coming into the economy from monetary authorities and finance ministries. And it doesn't seem to be helping the real economy, consumption and production. But the stock market just keeps going up and up and up and up. And you have this market, you have this economy that's been kind of treading water for most of the time since 2008. There was a recovery, but it wasn't that great. And it wasn't that great for about 10 years. And then we had another recession. The economy really hasn't benefited from all that monetary largesse, but the stock market has. And there are a couple of reasons for that, but one of them is that a lot of that money has gone into corporations and wealthy individuals who own those corporations. And another thing is that those corporations have been running profits. They're still every year the financial markets say, profits are going to be down in U.S. listed companies, and then they're not. But they're not reinvesting their profits, and they're not reinvesting that money from the government in new factories or new equipment or new employees. What they're doing is they're buying back their stock. That limits the supply of the stock, and it drives the price up. So from an investor and a corporate perspective, the investors in those stocks are doing well because there's a capital appreciation in the stocks. And then the CEO comes back and says, you should be paying me $40 million because look what I've done for your stock. And they say, sure, whatever you want. I mean, we've made a lot of money here. So from a corporate perspective, that's what's going on. But on an economic perspective, what you're doing is you're impoverishing the overall economy for the sake of the shareholders and the CEOs. And you're not investing in new plant, and you're not investing in new equipment. I'll give you a different story. Maybe 15 years ago, we were doing a lot of work in the cotton industry, and the spinning mills in the southeastern part of the United States, the Carolinas and Georgia, where they grow a lot of cotton, were all closing down and being replaced by Chinese mills. And there was one guy who ran a spinning mill who went to the American Copper Council and said, we really should be fighting this. And he found that there was no interest in it because all of those companies that were shutting down their U.S. plants had relationships with the Chinese companies. And those Chinese companies were manufacturing the products, the mill cotton products that these guys had for a fraction of the cost. And so they were like, no, we're not going to fight Chinese imports of cotton products because we're the ones importing it. Mm-hmm. And so that's decapitalization. It's not good for the economy, but it's good for shareholders and wealthy individuals and the executives who run those companies.
Yeah, I think that was a great way to explain it and understand it, and I appreciate that perspective, Jeff. So go ahead.
If I can expand, because there's another thing. A lot of people say, well, we're losing jobs to overseas, and I was talking about Chinese mills and stuff. The reality is that and they also say that America makes nothing anymore. American manufactured output is actually like 50% higher than it was in the 80s. We're producing 50% more than we used to in dollar value. But our employment is off like 2/3 in manufacturing. So we've actually lost more jobs to computers and computer-assisted manufacturing and computerized manufacturing now than we have to overseas jobs.
So that kind of goes back towards the idea that technology can be a very deflationary force. Is that right?
Yes, exactly. I mean, it's the famous thing when Henry Ford the first was showing his production line to some investors, and they said, "Yeah, but who's going to be able to afford your cars?" And he said, "They'll find jobs elsewhere."
So, Jeff, I'd like to move to the silver market. Obviously, you know a ton about it. So, why don't we start by explaining how big the silver market actually is, and what, for example, is the working inventory?
The working inventory. Well, first off, what is the silver market? Talk about the physical silver market. You have about 900 million to 1 billion ounces of newly refined silver entering the market every year. And you have, I think, probably about 800 or 900 million ounces being used in fabricated products. Now, a lot of that's jewelry and silverware and decorative objects. But there's also maybe 1/3 of that almost now is electronics. You have solar power using about 100 million ounces a year. And then there's just this incredible list of products, mirrors, bearings, solders, ethylene oxide catalysts, all sorts of stuff that use silver. So that's like, if you think about it as a financial accounting, that's the current account of silver. A billion ounces coming in, and the difference between that and fabrication demand is inventory building, either by investors, mostly by investors, but sometimes by market makers or producers or consumers. And so that's the current flow. Now, you also have the capital stock, if you will, which is the amount of silver that's out there in refined form, which is maybe 3 billion ounces of bullion bars and another 2 billion ounces of coins that are held mostly by investors. And then there's another 24, 25 billion ounces that's estimated to be held in jewelry and decorative objects and altars and religious objects and other things like that. So that's the capital stock. But then you have to say, okay, so that's the capital stock in the current account in the physical market. But let's talk about that silver market, the current account, because that's where it gets complicated. Because it all doesn't come in once a year and go out once a year. You look at it, and you have a mining company. They'll produce silver in doré form, semi-refined bullion, or in concentrates. They'll sell it to a smelter if it's in concentrate, or to a refiner. But they don't actually sell it to those guys because they want their money right away. And the smelter or refinery says, well, I don't know how much silver is actually in your shipment. So I will smelt it and then refine it, or I'll refine it and then we'll know how much there is and I'll pay you for it. So what happens is they find a financial intermediary. Says, I will buy your metal, you assay it, and once it's out of your control, as soon as it leaves your mine gate and it's picked up by an independent carrier to ship it to the smelter or the refinery, I will pay you 80% of the assayed value. And then when it's finally done, I'll pay you the 20% remainder, right? And I'm going to borrow gold and silver and sell it in the market so as to protect myself from the fact that the price could change while the stuff's being processed. That's the first transaction. But now you have a smelter. They smelt it. They need to borrow money, so they probably borrow metal. They smelt it. They ship it to a refinery. The refinery is processing doré. The refinery is processing scrap. The refinery is processing metal that comes from the smelter. They borrow silver to finance their working inventories. And then they send it to a converter who says, okay, this is a bar. My client needs a plating solution, or my client needs little pellets to use in making jewelry, or my client needs a sputtering target to make electronics products. So they convert the bullion into a product, and that might go to, let's say, it goes from the converter to a plater who plates a substrate like a copper or aluminum substrate with silver. That goes to a stamper who stamps it into a form. That goes to a jewelry semi-manufacturer or a findings manufacturer or electronics company, which might put it into the structure to hold a semiconductor. That goes to a company that puts that semiconductor together. That goes to a company that puts the semiconductor on a board. That goes to a guy who puts it into a computer or a car or somebody else. That goes to a wholesaler. That goes to a retailer, and that goes to an end consumer. So all of a sudden you have 10 transactions. So when you're talking about the physical market, we're guilty because we talk about, well, the physical market's a billion ounces. But if you think about it, those billion ounces are turning over and over and over. And it might be 10 or 12 transactions from the time it leaves the mine to the time it goes to an end consumer or investor. So it's not a billion ounces, it's 10 billion ounces, right? And we kind of oversimplify it for people, and that has probably led to some confusion. Then you have the derivatives markets, which is an entirely different game.
Mm-hmm. So, and basically every or most of those steps along the way, Jeff, as you explained, that metal is basically being leased so that it's hedged between when it gets, let's say, sold and delivered, right?
Right, exactly. I mean, a jewelry manufacturer says, I want you to lend me silver, put it in my plant, and when I've made the jewelry and I sell it, I'll buy the silver content and pay you for that, and then ask you to top off my lease. And the mining company on the other side says, no, I don't want to wait until this stuff is sold in jewelry form. I want 80% of the value as soon as the stuff leaves my gate. Yeah. And every step in between has to be financed. And you look at a lot of those semi-fabricators that I was mentioning, a lot of them are private companies around the world. Some of them are small publicly held companies. Their cost of money is 10 to 18%. A lot of these guys live off their credit cards. So say, okay, I need working capital to finance this inventory, and precious metals are expensive, right? So where am I going to get it? Am I going to pay 14% interest on it for dollars to borrow when I can borrow silver for 3%? And in borrowing silver instead of dollars, I'm perfectly hedged because I don't have to buy that silver until the day I sell it in jewelry form. I can call my bank and say, what's your price of silver today? He says, $27.50. I go to my client and I say, I'm shipping you 1,000 ounces contained in silver, and I'm charging you $28. The cost to me plus the manufacturing costs plus the financing fees. And then I say, to my bank, top me off with 1,000 ounces because I need that working inventory. So that's how a lot of this stuff is financed. It's 3% instead of 14%. That's great. So yeah, there's a tremendous amount of silver that's out there in the float.
So what has happened to the average grade of silver over the past 15 to 20 years, Jeff? And is this an indication that the world is running out of silver?
Yeah. In our silver yearbook, we have that table, and we put that table in there expressly because people are holding that up. The grade of silver has declined sharply. I don't have the report, but it's right behind me. I could get you the numbers if you wanted. The grade of silver has declined by more than 50% over the last 15 years. The average grade of silver mined. That's not a sign that the world is running out of silver. What it is a sign of is improved technology for mining and refining that allows miners to mine lower grade materials. But more importantly, it reflects the increase in price. The silver price is triple, or more than triple what it was in 2005. 2005, it was $5, $6, $7 an ounce. It's $27 as we speak.
I pulled it up. I pulled it up right here, Jeff. So the average grade in 2005 was 13, I believe it's grams per ton, and it's dropped to 5.8 in 2020. The price in 2005 has gone from $7.26 to $20.67 in 2020.
Yeah. So you've got a tripling of the price, which allows the mining companies to more. You also, if you have that table, you also have the value of a ton of ore, which has probably gone up threefold.
So in 2005, it was 94.38, and in 2020, it's gone to 119.89. Okay,
so it's not threefold, but it's a significant increase. So the mining companies are profitable now, mining in a lower average grade. And the decline in the grade represents the fact that the price has risen.
Yeah, and that also speaks to the reserves versus the resources as the reserves have grown over the years, correct?
Yeah, before I even got into university, there was this Club of Rome and Future Shock. There were all these futurists who were saying, oh, look, you look at the amount of gold, silver, oil, copper in reserves, and we're going to run out of oil and copper by 1980. This is like 1970, 71. We're going to run out of copper and oil and gold and silver by the early 1980s. And what they didn't realize is that there's reserves which are mineable, profitably mineable ores in the ground, and resources which are not profitable at current prices, but could be profitable at reasonably expected prices. So by 1980, the price of silver had gone from $1.29 to $16. So it basically had gone up tenfold, and you had this massive increase in reserves. And it's just continued along that route. So you've had this constant thing. In 1970, people said, we're going to run out of silver by 1980. In 1981, Jerome Smith said, we're going to run out of silver by 1985. And if you go forward, you can see that, in 1980, we had 7 billion ounces of reserves. And today we have like 15 billion ounces of reserves. And in the intervening 4 decades, we've mined 20 billion ounces of silver. So we've mined 3 times what we had thought of as reserves. And the difference is the price is higher, so those resources become converted on paper to reserves. Mm-hmm. And then when the price falls, they go back into being resources. So when you see these mining companies say, well, our resources increased sharply in 2020, you have to say, okay, how much of that was actual discoveries of reserves, and how much of it was revaluing your resources to a level where they became reserves?
Yeah, and I guess another way to think about it, or to, let's say, simplify it, would be that if you were a mining company and you had some low grade ore and the price of silver is high, you can profitably produce that ore versus having a low price of silver and mining just your high grade ore, right?
Right. In fact, South Africa used to have a law on its books back up until the early 90s that miners had to mine the average payable grade. And the purpose of that law was to preserve mineral resources for as long as possible. So that you would say, okay, when the price is high, you mine a lower average grade and you can generate fair profits. And then when the price falls, you can mine a higher grade. In some places you'll find miners high grading during times of low prices. And what you do is you shorten the mine life. Another thing that's often misunderstood is mine life. It's initial mine life or current mine life. Because a lot of miners will prove out 10 years or 15 years worth of reserves, and they won't bother to drill out more because that's enough to satisfy the equity markets, And in Mexico, Peru, and in China in particular, those countries have different frames of references for their equity markets. Investors are much more longer term focused than the short term investors in North America. So they don't drill it out. So they get upset because you see all these Canadian miners say, well, we've got more reserves than so-and-so and so-and-so. Well, all these Peruvian and Mexican companies don't have as much reserves as we have. And, the people who run the Mexican and Peruvian companies say, that's because we don't bother to drill it out, because we don't need to. I mean, we are the Fresnillo mine. We've been running it for 500 years, and we've never had more than 10 years worth of reserves. Homestake mining, when it was around, it was like the U.S. gold mining company. It ran the Homestake mine in South Dakota from the 1880s until probably 20 years ago. It never had more than 10 years worth of reserves. Why bother to drill it out?
Right. Yeah, it's an excellent point, Jeff. So something else that has garnered a lot of attention recently was that the LBMA came out and explained that they made a mistake in stating how much silver was in their depositories. So was this, to you, a significant error? And this kind of plays into our discussion of how big the silver market actually is, right?
I would say it's an significant error. Okay. And let me explain why it's significant. It's significant because it was like 100 some odd million ounces. There was a lot of silver that was miscounted. Mm-hmm. And that's sort of a sloppy error. And it appears, according to the LBMA and everybody I've talked to, it appears that one of the depositories misreported its data for the end of March. And they caught that when they were compiling their data for the end of April. So it was a big error. And it's an embarrassing error for the London market. But understand, the London market only started reporting depository holdings in July of 2016. So they're kind of freshmen at this. But it's really, so it's a significant error from that perspective. It's insignificant from this perspective. If you talk to people in the core market, mining companies, smelters, refiners, fabricators, traders, bullion dealers, no one paid attention to it because the amount of silver held in London pretty much is not important to them. So it was an insignificant factor to the silver market. there are some people who are not part of the core silver market for whom, oh my God, this is terrible. This must be some sort of conspiracy. But the silver market itself said, well, first off, until 2016, we never knew. Yeah. And the silver market goes on day by day without knowing. And we don't really pay attention to that. Maybe Jeff does in New York, but, most of us don't. If you go back about 10 years ago when the London market was being reformed and they were going from having gold, silver, platinum, palladium fixes to having the current pricing system, the London market was having these dial-in conversations. What should we do? How should we do this? And CPM Group was the only North American participant in those conversations. All of the mining companies in Toronto and Vancouver and Denver didn't think it was important enough for them to get up at 5 a.m. to participate in that London discussion. Mm-hmm. So that tells you that speaks to it's not really significant.
Mm-hmm. So
it's like knowing how your carburetor works.
Well, that's important to me, but
yeah.
not everybody. It's not necessary, right?
Mm-hmm.
So something else that was brought up as we're talking about the LBMA, Jeff, something else that was brought up by a past guest on the show was that the London lease rates were spiking. So in your opinion, was this more due to a logistical issue?
Well, I wasn't looking at them, but so I don't know what it was causing, but it was probably a logistical issue. I mean, the reality is that London gold and silver inventories are at record levels. Well, they're down a little bit, but they're still very, very high, and they're far higher than they have ever been before. So there's plenty of metal out there. Part of the question is ownership and availability of that metal. But right now, I think it's probably there. Also, you have to understand the lease rates are calculated. They're a function of the spot, the forward spread, and the interest rate. And then there is a risk premium that's added in. So it could have been the interest rate changes that caused it, or it could have been some spot to forward spread. It could have been some tightness that caused it. It wasn't so important that anybody asked us about it.
Are they not calculated at the end of the month, and it could show a spike at the end of the month instead of just averaging through the month?
Yeah, we talked about this the other day. Lease rates are calculated on a daily basis, but in terms of the lease rates that are used for forward transactions and leases and some other hypothecations of the metals, a lot of those contracts say that the lease rate on the last trading day of the month will be used for pricing the forward or the lease payment that's due. And so that happens too. And it's oftentimes you'll see a spike in the lease rate at the end of the month because of the turnover from one month to the next, especially if the next month is an active month on the Comex or the NYMEX or platinum and palladium. So you'll see a spike up and people will get hit. And one of the things that we've done with our clients over the past is if the client has enough economic clout, they can negotiate to say, no, I want the average lease rate for the month, or I want the average lease rate of the month, but I also want to be able to lock it in for 3 months or 6 months or 12 months. We had one client that locked it in for 24 months because they were a very large producer and they probably understood the bullion market at least as well as their bank counterparts.
Mm-hmm. So as we talk about inventories being at all-time highs, Jeff, does this mean that it's available for sale, or is it owned by ETFs or different entities like that?
Well, in London, you've got about 725 million ounces owned by ETFs. And so that stuff is allocated and it's not readily available, but it's saleable at a moment's notice, right? People can sell it. And in fact, one of the things that we saw last year was large purchases of ETFs actually by banks and then sales of those ETFs later on. And that reflected some changes in the structure and the predisposition toward precious metals of those banks, So that stuff's not readily available. Or it's not available immediately, but it can be available in a minute, right? If the owners decide to sell. But, okay, so you have 725 million ounces in London, and then you have an additional 450 million ounces, I think, that's not allocated to ETFs. Some of it's allocated to other people. We just don't have the numbers on it. They don't provide that data, but most of it's held on an unallocated basis. Mm-hmm. And then in New York, I think you've got about 360 million ounces of silver or so, and most of that is unallocated.
So as we're talking about unallocated and banks taking delivery, there was a recent report from the Comex that showed that JP Morgan was taking delivery of 44% of the deliveries made to date for clients. Is this business as usual?
Actually, it is. I mean, if you look at that, you're looking at the issues and stops, delivery notices of the companies. And if you look at it, yeah, it's business as usual. First off, the size of the deliveries is in line with the delivery rates over the last several years. I mean, if you go back to 2017 and you go through March, the last active month, delivery month here, you'll find that there were 11 delivery months that had anywhere from, I think had 35 million ounces of deliveries in May, in the May contract. And you're down to like 1 million ounces left. So you had 35 million ounces, and there were 11 months that had more than 35. And, one of them had 86 million ounces. And it's very important to understand that those large delivery months go back all the way to 2017. So this far predates the Wall Street silver people being involved in the market. This is business as usual. And if you go back even further, we have data going back, gosh knows how far. You can see that it has risen with the size of the markets. Now, in terms of the fact that JP Morgan had 44%, yes, that's also business as usual. They are one of the larger people. Morgan Stanley and Bank of America also had larger pieces, but it was like 18%, I think, and 27% so far this month. But one of the problems with some people is they look at the world in silver-tinted glasses. Say, oh my God, look at this massive concentration in the top 3 or 4 banks. But if you step back and you say, well, let's look at gold, silver, platinum, palladium, copper, or you step back further and you say, let's look at commodities, what you find is that the concentration of issues and stops and activity among the top 4 banks of silver is actually right in the mean of commodities in general. So it doesn't jump out like, wow, this is something that's radically different in silver compared to all other commodities. In fact, half of the commodities have more concentration than other things. We did these numbers back in 2010, 2011, when some Canadian was trying to convince people that the world was running out of silver and there was a conspiracy to manipulate the silver price and that there was this undue consolidation. And we put out all these tables together, charts together, and we said, look, silver's just another commodity here in terms of concentration. But then you could take another step back. You say, what about banking? And if you look at it, something like the vast majority of mortgages are handled by 3 banks now in the United States. And you can look at almost any sector of banking, and what you find is there are 3 or 4 banks that represent the majority of the activity, because the banking industry over the last 20 years or longer has gone into the specialization mode. And most banks that used to trade metals are out of that business. And, you call a bank and you say, hey, I want to do this. They'll call JP Morgan and say, hey, I have a client who wants to do this. Give me a price. So it's not unusual. It's not specific to silver. It's in line not only with other commodities, but it's also in line with the broader banking issue.
So, Jeff, are you saying that really applies to the short position that's held in silver? The charts that I've seen show that there's short positions equal to around 180 days of silver production, and is that what you're referring to?
No, I was referring to the issues and stops, but it's also true
Okay.
of the short position. The short position, the short positions are almost exclusively hedges of long positions elsewhere. And those elsewheres are two places. It's all that metal that I was talking about being leased. And it's very funny because if you start talking about and you do some analysis on how much silver is on lease with producers, processors, and fabricators, you stop saying, well, man, there's this massive short position on the Comex. You start saying, where's the rest of it hedged? Because there should be much bigger hedges than there are short positions on the Comex. And the answer is most of it's hedged on the OTC market, because that's actually the most efficient place to hedge. If you can't hedge it on the OTC market, you hedge it on the Comex. If you can, you will actually liquidate some of your positions on the Comex and transfer them into the physical market and do OTC hedges because, in some ways they're preferable. Although since 2008, 2009, when the credit markets froze up, we have seen a shift toward futures away from OTC trading. Again, not in silver, across all financial markets. And actually that is a trend that started in 2000, 2001 with not so much the Commodities Trade Modernization Act of 2000, but actually there were changes in the way hedge fund accounting could be done. And prior to that time, hedge funds never traded, and certain other institutional investors never traded futures. They trade forwards, or they would trade structured notes with a bank, and the bank would hedge that position on the futures market. And there were tax implications that kept people from trading futures. And then the tax laws for these institutional investors were changed around 2001, 2002, maybe with Sarbanes-Oxley, I'm not sure. And at that point, people said, well, then I'd rather trade on the futures market because there's a clearinghouse. It's not a principal transaction. So you saw that shift. But again, yeah, that concentration is there because it's a hedge of those physical leases, and those physical leases are handled by an ever smaller number of banks.
So as you're talking about the let's say the physical holdings of these banks, that gives us an indication that these short positions are held to hedge, not to be naked short in the market, right?
Absolutely.
Okay, perfect. So there's an interesting story in the report about how Spanish, Cuban, Mexican, and U.S. silver coins were used in China as currency before the Communist Party took over in 1949. Then in 1955, the government had said that it had all been turned into the government. Was this true? And do circumstances like this account for supplies of unreported silver?
Yeah, that's part of it. I mean, the story is that, China for hundreds of years prior to the communist takeover was racked by civil wars and divisions. And there was if there was a central government, it was weak and it wasn't necessarily paid attention to by other parts of the country. And in that kind of environment, paper currencies were kind of meaningless or of less value. So a lot of the transactions were done in silver and larger transactions in gold in China. And they used imported coins because China at the time did not have a history of mining silver. So it's actually very interesting because a lot of the silver that was plundered in Central America and Mexico made its way to Europe. Spain, Portugal, and the Dutch were the original guys bringing it over. And they all had gold standards, but the British had a bimetallic standard. So they could take their silver to England and trade it for gold with the government. The government said, gold is worth 16 times silver. So they started flooding England with all of this silver. England, meanwhile, was trying to trade with India and China. And they kept going over there because they wanted silk, they wanted the spices, they wanted everything that China and India had. And the Chinese and Indians would say, well, what do you got in turn to give me? And they said, well, we got wool, so you got gin? No, So we got all this silver that's flooding the market and really disrupting our currency system, which is bimetallic. Oh yeah, we'll take the silver. So a lot of that silver, billions of ounces of silver came from Latin America to Europe to England to China and India. And it's still there. And it's unreported. And, 400 years of civil war, you don't go saying, oh yeah, I got all this silver buried in my backyard. You just don't do that. So that's where a lot of that stuff came from. And then, yeah, when Mao took over and the communists took over in 1949, they said, turn in all your silver.
So then the story goes on to say that when you started working for J. Aron, they were still buying that silver that the Communist Party supposedly took out of circulation, correct?
Yeah, and I'll actually give you an even cuter, more recent story. Yeah. So I was studying Chinese economics in the mid-'70s, and I read, oh yeah, China, and everybody turned in their silver. 1955, it was done. Fast forward to 1980, and I go to work at J. Aron, and I said, so, here's our client bill. Oh, yeah, People's Bank of China. Bank of China as agent for People's Bank of China. Well, what are you doing? Well, there's some gold transactions, but every month we're a net buyer of silver. What kind of silver? Melted down coins. Because the People's Bank of China was the market maker for gold and silver in China up until 2001. So they did that, and so they continued to do that up until the time they got out of being the market makers. And there are all kinds of cute stories I could tell you there. But the one story I will tell you is if you look at when Berkshire Hathaway was taking delivery of its silver, they started taking delivery in January of 1998, and the price of silver started rising. And then in the end, and the way the OTC delivery process is I bought forward from you, you've sold forward to me. The last week of the month of delivery, before the month of delivery, I have to tell you whether or not I want to take delivery of that forward I bought from you. So in the last week of December of 1997, Salomon Brothers, which was the agent for Berkshire Hathaway, started sending out delivery notices. Yeah, we want to take delivery. You're Salomon Brothers. You don't take delivery. You just trade back and forth. You never take delivery. Well, this is for our client. So it's Christmas week. Everybody's on vacation. And all of a sudden, all these counterparts have to scrounge around and find silver to meet their obligations for delivery in January. So the price starts rising. And I won't tell you about there are so many cute stories here. But then in late January, the second notices go out for February delivery. And one of the entities was a Chinese bank that had somehow or other been completely oblivious to what was going on in January. So they get a notice from Saudi that they want like 5 million ounces of silver. And they go into the silver market to try to borrow 5 million ounces of silver at a time when other people are scrounging to meet their commitments to deliver in February. And the lease rate shot up. I think it got to 80% for a day or two. And it was because somebody didn't understand what was going on or wasn't aware of it. And they came in looking to borrow silver in a very tight market. And again, very important, it lasted for a day. And then it was resolved and the lease rate came back down.
And as you're talking about that period of time, Jeff, there was also like into that price rise, there was massive gross selling as well, right?
Yeah, I mean, 1997, 1998 was a period of time when investors as a group were basically net sellers of several 100 million ounces a year. The price of silver had gotten to $50. Everybody started buying, and it came down to $16 within 3 months. And they said, that's okay, it's going back to 50. And they continued to buy through the 80s, but by 1990, they had gotten disillusioned, and they became net sellers. And they were net sellers from 1990 to 2005. Mm-hmm. And so Berkshire Hathaway was actually buying silver, at prices below $5 an ounce at a time when most other investors were net sellers.
So as we're talking about these famous silver squeezes, Jeff, you also have personal knowledge of the Hunt brothers situation. So what were the three main mistakes that you saw them make?
I mean, first off, the Hunts didn't try to squeeze the market or corner the market. The Hunts looked at the silver market and said, this is a market that's tight and it's going to get tight. And it was the 1970s. So everything, was being deregulated. Gold prices have been deregulated. Silver prices have been deregulated. Oil prices have been taken control of by OPEC instead of Saudi Aramco. which, the U.S. part of Saudi Aramco kept the price fixed until 1971 or so. So everything was being deregulated. There was high inflation, 14% inflation at the peak in 1979, early 1980. And the Hunt said, in this environment, silver is going to rise sharply. So they bought a lot of silver, and they bought silver futures, and they also bought some over-the-counter options that were still available on a grandfathered basis. Commodity options had been prohibited in the United States from 1975 to 1985 by the creation of the Commodities Futures Trading Commission. They said, we're going to clean up the futures market, and then give us 10 years, and then we'll turn our attention to options. So the Hunts had futures, options, and so the one mistake they did was they were taking their profits as the price of silver rose. Their futures contracts had margins being paid to them. The guys who were short had to put up margin to prove to the clearinghouse that they had the financial wherewithal to meet their short commitments. And the guys who were long, including the Hunts, would be credited with those margins. So they had a tremendous amount of money in their margins. And one of the mistakes they did is they took those margin dollars and they bought stocks. Texaco, I think, was one. It wasn't Beige, it was Halsey Stewart Shields. Brokerage house was one. They bought a lot of stocks which were less liquid. So they had taken their money, which was liquid in a clearinghouse, and put it into less liquid assets. That's the first mistake. Second mistake is the Comex and CME and CBOT didn't change the rules on them. They imposed them. And they didn't pay attention to the fact that one of the rules across markets, equities, the LME has it, is that if a market looks like it's going to break or go insolvent and generate significant macroeconomic stress to the financial system, the committee at the exchange can impose such rules as are needed to restore order. So it's not that they changed the rules and imposed liquidation only orders. They imposed the rules that already existed. And the third thing was just a mechanical thing. Nelson Hunt was the only guy who was authorized to move money into their margin account. And he was off trying, they made a lot of money all the way up to $50. And then liquidation only orders came in and the price started declining. And rather than sell his silver and sell his stock, he was doing some of that. But what he was really trying to do was find people who would buy silver-backed bonds to give him the money that he needed to meet the margins. And Nelson had a strange way of traveling. He would drive out to Dallas-Fort Worth Airport in his car, station wagon, and he'd go to the counter and he'd buy a one-way ticket and pay for it with cash. And he'd fly off to wherever he was flying. And he was the only person who could authorize a transfer of money into their bank accounts to meet the margins. So he had flown off to Paris to try to convince some of his counterparts there to buy these silver bonds. They said no. So he checked out from the hotel he always stayed at, and he flew off to Saudi Arabia to try to convince some of his friends there to buy these silver-backed bonds. Brokerage calls his secretary and says, you need to put up X dollars margin by 8 o'clock, 8:30 tomorrow morning, or else we have to liquidate the positions. She calls the hotel in Paris. They say, oh, Mr. Hunt checked out. Go, where did he go? He went into the airport. Okay, do you know where he flew to? No, we don't. We just knew we got him a taxi to the airport. So he was incommunicado, and they couldn't wire the money in to meet that margin requirement. They had the money to meet the margin requirement, but they didn't wire it because no one was authorized except a guy who was on a plane en route to Saudi Arabia. And that was the third mistake that they made.
It's an interesting story, Jeff. I'd like to turn a little bit to how we've seen demand progress over, let's say, the past year, since or year and a half since the start of 2020. And maybe can you contrast for us the retail demand versus institutional demand for silver?
I'm not sure how much I can break that down, but yeah, first off, you had this period of time, as I said, investors were net sellers as a group up until 2005. Then they turned into net buyers. And they were buying enormous amounts of silver, 150, 200, 220 million ounces a year on a net basis, 2008 to 2011, 2012. And then they started buying less, just like in the 1980s. Price of silver didn't rise, it fell. The world didn't collapse, it got better. The dollar didn't collapse, so the price of silver was falling and the investment demand was falling. And it got very low, 2017, 18, 19. I think 40 million ounces a year on average in those years. And at that level, the price of silver was sort of flatlining. Middle of 2019, there were some economic developments that caused people to sort of look at it. Things in gold and silver spiked higher, then they came back down. And then they spiked higher in early 2020, and then they came back down during the financial crunch in March, and then they kept going up. And what we saw was last year investors bought, I think our number is about 100 million ounces, or about 80 million ounces. I'm sorry, it's about 80 million ounces plus on a net basis last year. Twice as much as they had bought in 2018 and 2019. And to some extent, the silver market wasn't geared up for that. Well, one of the things we haven't talked about is the fact that several major bullion banks had decided in 2019 to basically either get out of or reduce their exposure to precious metals trading. So that was reducing the liquidity and the number of counterparts in the market. Plus you had banks or you had refineries that made bullion bars, small investment bars, and medallions. And they were shut down by the COVID thing. And they were also geared to produce half as much metal because that's what the market had wanted for the previous 3 years. They weren't geared up. They didn't have the staffing and manpower and credit to gear up. And the same was true with national mints that make the coins. And you have to understand, it wasn't that they doubled the volume of silver, but the price of silver more than doubled. So the credit requirements, you're saying, okay, I'm a private refinery and I've been financially constrained for 3 years. And I've been going to my bank saying, hey, please don't cut my credit lines because I'd like to grow my business, not contract it. And the bank says, you don't understand. We're getting out of this business. You need to find somebody else to lend you that silver. And then the price of silver doubles and the volume of silver doubles. You say, so you go into your bank and you say, I don't need to double my credit line. I need to quadruple it. Because you don't understand. I'm closing up shop. You don't even get to keep what you've got in terms of a credit line. You've got to find somebody new. So there was a lot of chaos in that market, which led to the volatility and stuff that was going on at that time. But you basically saw a doubling of investment bank. Now, how much of that was institutional versus individual? It's really hard to say. A lot of the silver demand is individual silver. Silver has always been perhaps more attractive to individuals, but I can assure you that there have been some pretty large institutional investors that have taken long positions in silver over the last 18 months.
Mm-hmm. So, Jeff, as we see spot price be so far from the physical price that we can buy let's say a silver eagle for, this premium is or really exists over the spot price. So my question is, do the futures markets really allow for true price discovery of silver, or is it just setting a derivative price?
The futures price is very closely aligned with the wholesale price in the physical market. There can be divergences, but by and large, the futures price is a very good measure of the equivalent of the physical market. So if you look at the price of a 1,000-ounce bar in the New York market versus the futures price, you're pretty close to it. And the divergence has been the premiums between a 1,000-ounce bar / futures and 100-ounce bars, 10-ounce bars, 1-ounce bonds. That's really what it's been. Now, just to jump forward to the next question that I'm guessing, is futures prices can affect the price on the short term, but the physical market sets the long-term price. It's quite clear if you look at the market the way we do, with great detail and great granularity, that from a long-term perspective, it's the physical market that determines whether the price of silver is $5 or $25. And it's the futures market that determines whether it falls 5 cents or 25 cents or 75 cents today or rises 75 cents.
So as we're talking about premiums, and you mentioned the 1,000-ounce bars, have the premiums that have gone up on the 1,000-ounce bars, does that indicate any shortness of silver in that market?
It doesn't represent a shortness of market. It represents increased demand for those bars, partly because there's been increased demand for those bars from a number of ETFs. And it largely represents an increase. So it's not necessarily a shortness. It's a matter of supply delivery issues, which you're seeing across the economy right now with supply chain delivery issues. Mm-hmm. As I said, you've got record amounts of silver on Comex and in London vaults. And you don't have reported data, but in Zurich and Switzerland, in China, in Singapore, you have record amounts of metal. And you see vaulting companies and depository companies opening silver and gold depositories in all of those markets because the metal just keeps stacking up. Now, some of that is allocated metal that investors are holding, and some of it's unallocated metal that banks are holding for investors. So there's clearly plenty of metal around, but there is a little bit of static between getting that metal and putting it into individual investor hands.
And I think part of that kind of goes back to let's say the secretive nature of the silver market. Is that fair?
I think it probably has a little bit to do with it, but yeah, I mean, you don't have the kinds of reporting that you have in the securities business or in the bond business.
So Jeff, do you have an explanation for instances when we see lots of silver dumped on the futures market, and some point this out as manipulation? So I'd like to get your thoughts on why this happens.
Yeah. Again, you're looking at the silver market in silver tinted glasses. Mm-hmm. And if you put gold tinted glasses on, you see the same thing. If you take a step back from precious metals, you see the same thing across commodities. If you take a step back from commodities, you see the same thing in currency, bonds, and equities. And what you're seeing is an increase in computerized trading. And, you have probably more than 90% of the trades across financial markets being generated, the buy and sell signals being generated by computers, all looking at the same price. And a lot of those computers don't even say to their users, I know you're mad, but I think you should sell. They do it automatically. I can give you a couple data points. First one is in April of 2013. The price of gold fell sharply in April 2013. And it fell because there was a lot of shorts. I mean, by the time you got to the end of March, the short position on the Comex was at a record level. And it was at a record level because there was this generalized bearishness. And it's very funny because my old alma mater, Goldman Sachs, was blamed for selling on April 13th. In January of 2013, Goldman Sachs issued a report that said, gold's going to $2,000 this year. Never been there before, but it's going to be there this year. And at the end of March, early April, somebody walked into the commodities research group and said, hey, take a look at this. Comex record short positions by institutional investors. Our clients are short, and you're telling them it's going to $2,000. Do something. Walk out. Mm-hmm. So Goldman in early April issues a sell recommendation. Like, geez, we just realized that everybody else in the world thinks that gold's going to fall. And a lot of the selling actually started in China because you had these people buying gold in advance of the Lunar New Year in February. And they thought that the price would hold above 1580 and go back up to about 1620. And it didn't. People in China did not buy during the Lunar New Year. In fact, and so the jewelers and retailers had a lot of excess inventories. And after the Lunar New Year holiday, they sold and the price went below 1580 and it stayed below 1580. And that was this giant sell signal. If you look at that day when the gold price fell, and there are any number of people who said it was Goldman Sachs selling, the data shows that there were more than 1,000 discrete entities selling gold in a 5-minute period because the price had fallen below, I think the price had fallen below 1380, if I recall correctly. And that was this massive trigger. And computers around the world said, whoa, sell. More than 1,000 entities. And when we pointed that out, one of the brighter people in the market said, you mean the Fed has more than 1,000 agents acting to sell all at once? It's like, no, I mean, there are 1,000 people trading futures based on a computer, and I all use the same program, and they're all looking at the same price, and the price says sell. You know, and it's that way. Now, interesting stuff. And you can go to our website. We have some presentations that we did at the Silver Summit 2010, 2011, 2012. And they cover some of these things. Those charts I was telling you earlier, comparing the concentration of open interest among banks across commodities. That's in one of those presentations. There's another table in one of those presentations where we say, let's look at, I think it was 2013. Let's look at the large moves, you know, the outsized aberrational moves in any 5-minute period over the course of the first 10 months of this year. And what we found was, let's say there were 7, I don't remember the numbers, 7 outsized moves where there were more than like 25 million ounces of gold or silver traded in a 5-minute period. And 4 of them were higher and 3 of them were lower. And you go back into the data and you find out that there were hundreds of entities buying and selling in those 5-minute periods. There was never somebody saying, oh, let me whack this market. So that's the reality. You know, and again, you see that across assets. It's not across commodities, it's across many. You see it in the currency markets, you see it in the stock market, you see it in Bitcoins. You know, you see it even in bogus assets like Bitcoins. You see that kind of behavior, right? But the interesting, you know, the corollary that's interesting is the guys who were saying that it was Goldman or somebody whacking the market were only looking at the times when the price fell sharply on heavy sales in the futures market, and they were missing the point that the price also rises, as Ernest Hemingway might have said, you know, and that in fact, more often than not, the prices were spiking higher on heavy volumes than spiking lower. Mm-hmm. So all of that sort of pulls together and says, you know, if you're sitting there saying, oh my God, it must be somebody doing that, you're using the wrong case. It's somebody's. Yeah.
So if we take, for example, I know there was a recent article written about, I think it was May 1st, 2011, where the price of silver dropped something like $6. Would you have the same explanation for that?
I don't remember that drop, but probably yes. Okay. Oh, 2011, I'm sorry, absolutely. And in fact, we told people about that. We even published a report and we were even on television talking about it. If you look at April, again, you're going into the May delivery, and at the beginning of April, the price of silver was about $32 an ounce. And over the course of April, the price went from $32 to $49, almost $50. And if you looked at the data at that time, no one was buying coins. Silver coin sales plunged because the price went from $32 to $40. And only an idiot would buy at $49 when a month ago he could buy at $32, right? So coin sales were flat to lower. ETF sales were sales. No one was buying ETFs. They were selling, taking advantage of the profits. But there was 378 million ounces of short positions in the May contract that were bought back and rolled forward into July. And that purchasing of the May contract is what drove the price from $32 to $50. So we were saying in April, dudes, don't get excited. This isn't going to 100. And once the May roll is over, it's going to fall back to $36. So if you see the price, high, sell in the last week of April. And in fact, the price fell the first week of May because you had the roll behind you. And the boys came on the internet and said, CPM Group's clearly working with JP Morgan to drive the silver price down. They knew this was coming. No, we didn't know that was coming. We know what the mechanics of the silver market are. You know how this works. You know, as you were talking earlier, that there's a certain value to bullion banks to having higher prices, and especially to having higher prices and a disrupted or a volatile market at the end of the month when the lease rate is set. So you could see this coming. It was there, and you didn't need a conspiracy theory to say this was coming, and that's what it was.
Okay. So another story that's gotten a lot of attention over the last year, Jeff, was that JP Morgan got fined $920 million for spoofing the market. So what is it that they were caught doing?
They were caught for spoofing the markets. Again, can't look at it in a precious metals shaded glass. You have to look at it. Most of the spoofing that they were caught with was in currencies, equities, and bond markets, and precious metals. And what JP Morgan was found, if you look at other recent cases, Deutsche Bank, Barclays, and such, the fine to the bank is for non-supervision of the traders. And then the individual traders that were spoofing the market are fined and sometimes banned from the market for life, and sometimes go to jail for it. So JP Morgan was unique in that it was across commodities. Usually, like Barclays, when they were fined, it was a trade by an option salesperson. And Barclays metals trading desk didn't even know that he was doing this. So forget the grand conspiracy. He wasn't working with other bankers at other banks. He wasn't even working with his own bankers. He put in orders to try to spoof the market for his own benefits. And Barclays was fined for not supervising him. And actually the same was true with Drexel, Burnham, Lambert, and Ted Butler in the 1980s. Ted was fined for trying to screw around with the orange juice market. Drexel was fined for non-supervision of a broker in South Florida who was jerking around with the orange juice market. So that's what you normally see. With JP Morgan, it was unique because what the court said, and it was a SEC, I think the Treasury was also involved. The settlement was with the SEC, the CFTC, and I think the Treasury too, because it spanned all these markets. It spanned equities, it spanned bonds, it spanned currencies and commodities. And what the settlement said was JP Morgan created an environment that encouraged spoofing.
So just
encouraged inappropriate trading.
Just for those that don't know, Jeff, could you define what spoofing is for us really quick?
Yeah, it's a little bit, well, it's not hard to define, but it's hard to make people who want to hear what they want to hear. People who listen for confirmation as opposed to comprehension. And I explained it someplace else, and some of the guys that you have interviewed immediately said, "Well, Jeff Crescent says, But let's try this. What you do with spoofing is you'll place orders that you don't intend to have executed. So you might place a bunch of buy orders to drive the price up because people see a lot of buying just above the market, or you might place a bunch of sell orders just below. And then when the price moves toward that level, you pull those orders. Now, it's important because in financial markets, the criminality is based on motives. And one of the insidious things about spoofing prior to the time Gary Gensler took over at the CFTC from Bart Chilton, he changed things. But one of the problems with spoofing across markets, again, is proving motive. Because if you're a trading company or a bank and your client says, I need to buy 100,000 ounces of silver, or 1 million ounces of silver, or 80 million ounces of silver today, now, you will probably put in a ladder of bids. Well, let's see what I can buy. The price is $27.50. Let's see what I can buy at $27.50, $27.60. And you'll put in a ladder of bids and see where you can get filled, because you want to buy as low as possible if you're doing your client well, properly. That's totally legitimate, and it's done across markets forever. But if you want to spoof the market, you can do the same thing. And a regulator looking in says, wow, that's weird. This guy's put this big ladder of orders in as if he's trying to drive the price down or drive the price up. I have to call him and say, hey, why are you doing that? And if he says, I've got this large order, I'm working for a client, I say, okay, thanks, carry on. If he says, I'm trying to jerk the market around, then that's spoofing. Mm-hmm. So spoofing is one of those crimes that's insidious and difficult because it mimics legitimate economic enterprise.
So you have to prove intent, really. You
have to prove intent. Mm-hmm. Now, a lot of times, we've been involved doing research for regulators, and you'll look and you'll say, this guy, all of his trades had no material effect on the price. They say, that's okay, because we have him on tape telling his floor broker, hammer the close. It's like, you don't say hammer the close if you're doing legitimate business, So we've got him red-handed. We're just trying to see if we can see what the cost to the economy and to other market participants was of his actions. And the reality is the costs were de minimis. Mm-hmm. You saw no material change the days when he was trying to hammer the market at the close to days when he wasn't. So, it's like, you're guilty. You must leave the commodities industry and never return. But the damages to people who have a class action suit against you are pittance.
Mm-hmm. So, Jeff, is there a big difference between trying to short squeeze an equity like, let's say, GameStop, and trying to squeeze a commodity like silver?
I don't know equity regulations. I'm not an equity kind of guy. Mm-hmm. But I believe that short squeezes in equities are legal. You can't try to defame a nationally chartered bank. So you can't try to drive a bank into bankruptcy. But I think companies, you're allowed to do it. But again, I'm not an equity guy. I don't know that stuff. Mm-hmm. I am a commodity guy, and I do know that it is inappropriate to try to manipulate the price, and that would include squeezing.
Mm-hmm. And does that have also to do with the naked short position on some of these equities versus, as far as we can tell, the banks not being naked short in silver?
Yeah. In the equity markets, when somebody's short a stock, they borrow that stock and then sold it in the expectation that when they need to return it, the price will be lower. They can buy it back at a lower price. So that actually is a naked short. And there are people who go naked short precious metals and other commodities. But the vast majority of the shorts are hedges of OTC positions. Mm-hmm. So there are two issues there. And one of them is a lot of those companies that have that short position. Well, first off, the easy one. Those short positions are not naked shorts. They're naked on the Comex, but there's an offsetting long. And by definition, under the CFTC definitions, they are bona fide hedges, so they're completely legitimate. Mm-hmm. The second thing that has been strangely quiet from the CFTC is, as I said, it is illegal to try to financially destroy a nationally chartered bank. So when somebody in Canada or northern tier states tells people, hey, let's all get together and try to destroy JP Morgan, that actually is, from my understanding, a criminal action.
Hmm. So, Jeff, considering all of your research on silver, what are your short-term views on silver? In mid-March, you guys issued a buy alert, and in it you were forecasting the price to rise into today because of the May contract roll. So can I get your let's say, short to midterm views on silver price?
Yeah. Well, the price did rise over the course of April into early May, partly because of the roll and also partly because of stronger investment demand. Our expectation is that over the next 2 to 5 months, the price of silver trades between, say, $23 and $30. We're going into a period of seasonal weakness. A lot of jewelers and electronics companies and other processors shut down on rolling 2-week vacations. Demand tends to slack off. Investors tend to slack off their demand during the summer months too. So there's some seasonal weakness in demand. And so we think that'll factor in. And you also have increased optimism about the economy in the United States and in Europe and in China. So we think that's probably kind of negative for precious metals. You have the rise in interest rates, which has been choppy, but it's clear where the trend is. It's toward higher rates. You've had some strength in the US dollar. It's choppy, but it could strengthen in line with the interest rates. So you have a number of factors that could cause silver to kind of tread water. That said, we're cognizant of the fact that in July of the last 2 years, gold and silver have risen into the first week of August because of the August gold Comex contract. September is the active silver. July and September are active silver. And so there has been, in the most recent 2 years, strength in July. So that's why we're saying, okay, this thing could drift down to $23 over the next month or two. But in July, it could move up, take out that $28 that it bounced off of this week, and move up as high as 32 or maybe even a little higher. Longer term, we think silver prices will rise to record levels, but possibly not for another 3 to 5 years.
So, Jeff, when we hear that once the silver price hits $30, it'll just continue to accumulate momentum, how do you look at that?
Never done it before. $30 is an interesting level, and you'll see some people buy it because, the last time it got to $30, it didn't move directly immediately, but it traded around 30, 32, 34 dollars for a couple months, and then you had the May contract, and it spiked up to 50, and then it blew off, and it went to 30, and it stayed there for a while, and then it went down to 20, and then down to 12. So, 30 is an interesting number. And I think that you could have some people, because, one of the things that you find in investors, one of the reasons why people disaggregate investment demand from fabrication demand in legitimate commodities research is you don't want to mix apples and oranges. And investors are radically different. They have different motives for buying than a fabricator. They keep the metal in a fungible form, so they can sell it at a moment's notice. And a lot of them do, because they are opportunistic investors looking to gain capital appreciation as opposed to long-term wealth holders. And the third thing is that investors will chase the price higher, where fabricators seek to reduce their per unit silver requirements when the price rises. So it is quite possible that if you saw the price move firmly above $30, that you could have follow-on buying that could take it higher. More likely what you're going to see, and what you've seen the last few times it's gotten to 30 or 32, is a lot of profit taking. So that's our expectation. And then for the bigger move, Jerome Smith in 1981 said the silver we'd run out of silver by 1985 and the price would be $100. And there's something magical about $100, because, people have been saying that silver price is going to spike to $100 since at least 1981. And maybe someday they'll be right. But the economics of mining and refining and 25 billion ounces of silver in jewelry that can get melted down and delivered, price can spike high, can't stay high.
I want to go back to something that you were just saying, Jeff, about the interest rates. How far do you think the interest rate can rise before that really puts the Fed in a tight spot?
We really haven't put a number on it, but we think that probably you need to see real interest rates of 3%, which would mean if you have 2% inflation, 5% nominal rates. And I don't know any mainstream economist that's talking about 5% nominal interest rates within the next 5 years. At some point, the interest rate probably shifts back. But, we were saying that in 2010, 2011. Hey, interest rates are going to have to rise higher. But then by 2011, 2012, we started realizing that the financial markets had changed in a fundamental way, several fundamental ways during the global financial crisis, and that we'd probably have an extended period of time that lasted more than a decade of low interest rates, which is what we've seen. So, I do think that at some point interest rates rise. But again, if you look at the Fed's projections, you never look at the Fed's inflation and GDP projections because they're always 100% off. But you look at what their expectations are on interest rates because that's what they know about. Mm-hmm. And they have interest rates staying very far below 5% nominal rates for the foreseeable future. Mm-hmm. And most general economists, mainstream economists, say the same thing. Mm-hmm.
Well, Jeff, I really want to thank you for a very wide-ranging conversation and a real deep dive into the silver market. Is there anything else that you'd like to mention to our listeners before we wrap up here?
Well, first off, I hope this helps. Mm-hmm. Again, you have to listen for comprehension, not confirmation. CPM Group has always tried to provide quality, unbiased research and statistics and analysis across commodities to retail investors as well as others. We have a really good track record. There's a tremendous wealth of free research available at www.cpmgroup.com, mm-hmm. Including, the Silver Summit presentations that I talked about.
We can link to those in the show notes as well.
Yeah. And then we have the open forum on silver coming up next Tuesday, May 25th, which is open to anybody. They can go to our website, I think, and probably find a registration form. And it's open. We've allocated 2 hours for it. We've asked Corey Fleck of Portland Economic Reports and a fellow who calls himself the Happy Hawaiian to moderate, mm-hmm. not moderate, but ask questions. We've talked to Happy, and he has gone through a list of questions that we've answered for him privately, and we said, feel free. At the end of which he said, how much of this can I say in public? And I said, well, there's a certain part about one particular investor, but other than that, you can talk about whatever you want. So anybody who registers can email in questions either before the open forum or during the open forum. And Corey and Happy will screen them, so there will be no questions about my hygiene or ethnic origins, I hope. Yeah. But substantive questions will make it through the filter. And the idea is exactly what this interview is, mm-hmm. to try to help people understand the mechanics of the silver market and answer the questions they have about why silver does what it does.
Mm-hmm. We can put that link in our show notes as well to the open forum and to where people can submit questions as well.
Sounds great.
Anything else, Jeff?
I think that's about it.
Excellent. Thanks so much for your time today, Jeff. Appreciate it.
Well, thanks for having me as a guest.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.